Fears of a recession growing on Wall Street as data starts coming in below expectations, indicating a potential slowdown. Joining me now, Neil Dutta, Renaissance Macro Research Head of Economic Research. Neil, great to have you. I know you say that much of what we see in the financial press, like tariffs, uncertainty, you call that a red herring for an economic slowdown that was already in motion. So what do you think is driving that slowdown?
Well, thanks for having me on, Maddie. I think it's primarily a function of monetary policy being too tight. I don't think people are pulling back, signing contracts on new and existing homes because they're worried about tariffs. I mean, think about that. So we know that new home sales have softened. Pending home sales are at new lows. Those represent signed contracts. And so that probably bleeds into residential investment over the next couple of months. And I think it'll in turn also weigh on residential construction activity, of course. And then when you think about incomes, I mean, the labor markets have been slowing for a while. If you look at quits rates, they have been low. Recruiting intensity has been low. And so inevitably, that's going to lead to weaker income growth. We're seeing that. And while DOGE and tariffs and all the rest of it gets the most attention, the truth is that state and local government spending and investment's been slowing for some time now, and that's projected to continue to slow into the next fiscal year. And that had been a major source of growth up until recently. So, to the extent that tariffs matter, I think that adds to the anxiety, but I don't think it's the principal cause of the anxiety.
So where does this leave our economy? How likely is a recession, in your view, for this year?
Well, it's hard to pencil in the recession call because the Fed has so much ammunition to deal with a meaningful economic slowdown.
Mm-hmm.
But it doesn't mean that you can't see a growth scare. So I think recession risks are rising, but I think once the Fed gets on the right side of the eight ball, those recession risks will decline. I mean, it's not unlike the period between June of last year and September of last year. If you recall, I mean, the Fed went peak hawkish in June, and then 3 months later, they're cutting 50 basis points. But I also reject the premise that the markets are actually really, I mean, this is not a growth scare trade, okay? Mm. I mean, this is largely just a momentum unwind. I mean, a lot of the winners are now being punted. If it was a real recession story, I mean, you'd expect financial stocks to be underperforming. You wouldn't see Europe outperforming. And there's a lot of things going on that are not really consistent with the growth scare. But what it does suggest, I mean, it's just another sort of notch on this idea that people are just trying to rationalize ex post something that was going on anyway. So they're trying to find, trying to fit a narrative to the data. But, I think if you peel back the onion, it's not really a recession story. To the extent that that's still out there, that means that there's more downside to the markets because that hasn't really been priced in. So I reject the premise that this is a recession fear story. This is a momentum unwind story more than anything else.
And I hear you when it comes to the impact of policy, but when I interview CEOs, they're all telling me that they're holding off on things like hiring, investing in the company, because they're waiting on clarity about not only tariffs, but the sequencing of policy, whether or not we're going to be getting the negative impacts of tariffs before the positive lift of those tax cuts. Do you completely discount the impact of those policy shifts?
Maddie, when things are going well, it's my growth strategy. When things are not going well, it's the economy in Washington, D.C. What did they think they were signing up for when they donated money to this guy's campaign?
I think they thought they were signing up for gains.
He ran on tariffs. He ran on that being his most favorite word in the dictionary. Now they're all surprised that he's going out and doing it. I mean, give me a break. It's just ridiculous. And also, more importantly, uncertainty would be high regardless of who was in office, because the Congress would have been evenly divided anyway. So I mean, would they be holding off if Kamala won and there was a potential tax cliff at the end of the year with corporate taxes going up substantially? Right. So it's, it's sort of like crocodile tears, in my opinion.
No, I understand and take your point on the policy positioning on either side of the aisle there, though I do wonder where that leaves investors if they are to follow your view that this slowdown is coming and that it's an unwind of the momentum trade. And I know you're an economist, but how should investors be thinking strategically about their positioning in this environment?
I think the way you should be thinking about this is trying to tune out the noise from DC and focus on the here and now. And what that means, in my opinion, is that the main risk to the economy is a passive tightening of monetary policy. Right now, the Fed seems to be playing a game of chicken with the administration. They're holding off on doing anything because they want to wait and see what happens with DC. At the same time, they've already been overestimating the strength in the economy. So there's a risk that by sitting back and waiting, and not doing anything, they're basically watching the economy slow down needlessly and not stepping in to stop arrest the slowdown. If you have a passive tightening of monetary policy, that'll put further downward pressure on economic growth and should push investors to take more defensive positions in the equity markets, in my opinion. That might mean consumer staples, maybe utilities. I'm not an equity market strategist, but that's sort of how I'd be thinking about it. And also to take long positions in the Treasury market, because ultimately I think the Fed will do the right thing, but there could be some pressure between now and then.
What is your outlook for the Fed this year?
I think they'll start cutting in June, and I think they'll end up doing more than what's priced into the markets at the moment.
And what do you think will be the catalyst for those cuts?
Weaker nominal growth. It's going to be very odd for them to maintain the same baseline of 2 rate cuts if they're revising down GDP growth and inflation at the same time.
So you anticipate a slowdown in that GDP growth coming sooner than the market might think?
It's already happening. Real personal consumption declined 0.5% in January. It's going to take a lot in the next couple of months to make up for that. Housing is still slowing, and and government spending is slowing. So remember, consumption and government were the 2 reasons why GDP sort of did really well in 2024. So how you think about those 2 things are going to have important sort of implications for how you think about this year. And real incomes net of transfers rose 1.5% over the last year. That's half the pace of consumption. So it just tells you that a lot of the driver of consumer spending in recent, over the last year has just been a drawdown of the savings rate. It's not sustainable. And as I mentioned, state and local governments are pulling back. So, that is going to prompt, I think, ongoing downward revisions to economic GDP expectations.
And really quick, as we end here, Neil, I want to get your take on the labor market. I know you see it weakening, but for those people looking for jobs who are listening and feel like the market's just been in a holding pattern, what do you think is going to cause that bigger crack in the labor market this year?
I think look, if you have a job, things are okay. If you're looking for one, things are not so good. And I think that's the challenge. If you think, unemployment, a lot of what's going on the unemployment side is really, it's taking longer for newly laid off people to transition into work.
Right.
And, that's why you have this kind of linear increase in the unemployment situation. Now, if there have been, at the margin, it does feel like layoff announcements have been going up. even irrespective of what's going on with Doge. Starbucks, you saw Southwest corporate laying people off. Autodesk reported layoffs, or job cuts are coming. So at the margin, it does feel a little bit worse. And I think the risk is that, if you get some modest increase in layoffs, you can get some pretty weak employment reports at that point because the hiring numbers are so weak, right? So it doesn't really take much in the way of layoff increase to kind of precipitate much weaker employment data.
Neil, I love that description of the job market. If you have a job, things are, well, okay. Neil, thank you so much for joining us this morning. Really appreciate it.
Thank you, Maddie.